Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice as I have access to lowest rates at the lowest cost in Arizona. If you don't believe me, call me. Here is this week's mortgage market at a glance. Inflation is bad for interest rates, and it's at the highest levels in decades. But the housing market has a far bigger problem. Actually, it's not hard for a problem to become bigger than rates right now, considering we're still at levels that would have been record lows at any other time before COVID. Moreover, rising rates within reason, of course, might help to tap the brakes on what has been an unprecedented disparity between supply and demand. That brings me to the big problem: supply, or rather, the lack thereof. Laminating the lack of housing inventory is a common refrain, but it's never been more relevant. The ill effects are increasingly visible as various home sales metrics have failed to advance over several months now. Last month's update on new home sales provided the most recent example, falling moderately and undershooting expectations. This doesn't mean people don't want to buy new homes. Rather, the range of $850,000 to $950,000 is simply about as fast as the housing industry can get things off the shelf in the current environment. The issue is more accurately visible when existing homes are added to the mix, as seen in last week's monthly update on pending home sales. Your eyes don't deceive you. We are indeed back at pre-COVID levels for pending sales. While some of the pullback could be driven by decrease in demand, record low inventories are almost exclusively responsible. One of the best places to witness the effects of the inventory crunch is in the home price reports. March's price numbers came out at the beginning of last week, and they leave nothing to the imagination. Of course not. In fact, it could be a self-correcting problem before too long. Just this week, several members of the Federal Reserve's Open Market Committee mentioned they're paying more attention to home prices, or rather, that home prices will factor into an eventual discussion of adjusting the Fed's bond buying portfolio. Fed bond buying is a major contributor to low rates. The Fed currently buys $40 billion a month in mortgage debt, in addition to reinvesting tens of billions of proceeds from previous mortgage bond purchases. The Fed knows that low rates grease the skids for home prices. If they're worried about the implications of rampant appreciation, they might cut their mortgage bond purchases faster or more than their treasury purchases. That's a bridge they'll cross when they come to it, though, and they haven't come to it yet. In fact, the Fed is committed to keeping policies accommodative until the economy has logged several months of much stronger data. They've also managed to convince markets not to be too spooked by temporary inflation spikes. It's not too much to ask the modern bond market to forgive the inflation spikes seen at times in the past decade. But the inflation spike seen in April's data is on another level. I already discussed the impressive reaction to the CPI data 2 weeks ago. Now last week, a similar report, Personal Consumption Expenditures, or PCE, gave markets another chance to save the inflation panic for another day. The core PCE price index, long said to be the Fed's preferred big picture inflation metric, and the one thing they're hoping to see in the 2s to 2.5 range for the next few months before gradually moving back down to 2%, rose to 3.1% from last month's 1.9% reading. This is the highest level in decades. At any other time in history, this sort of swing would have seen interest rates screaming higher and at record pace. Instead, here's how bonds and rates traded on the day of the release. In other words, there was effectively zero reaction to the inflation numbers. Rates were more keen to move for end-of-month housekeeping reasons, and they moved lower to boot. Markets take the Fed at their word regarding inflation. As such, it's a waiting game to see how things will evolve in the coming months. Without a decisive bias in economic data, rates might have a tough time finding enough inspiration to make the sort of moves seen in the first 3 months of the year. This isn't to say economic data is incapable of influencing rates in the short term, just that it's a high bar to clear. If any report is up to the challenge, it's this Friday's big jobs report. Granted, it can't fundamentally alter rate momentum in a lasting way, but it can definitely cause some volatility. So stay tuned for that. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that is for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice, so give me a call. Until next time, take care and stay safe.